So it's already 5 now, and the participants are joining in, but without much delay, the speaker has also joined. So I welcome all the participants, and I request the team admin to allow all the participants to join in for the meeting. Vishal sir, with your permission, if you are ready, can we start with the session?
Yes, ma'am.
Yes, good evening and a warm welcome to all the participants to this 10 days International Tax Refresher Course series organized by the Pune branch of ICAI. I, CA Amruta Kulkarni, Vice Chairperson of the Pune branch of ICAI, welcome you all. I welcome the presence of CA Vishal Solanki, the speaker for the day. We will be discussing today on the transfer pricing audit report, like for gearing up form for Form 3CEB for the financial year 2023. He will be sharing the relevant role of the practicing CAs, especially relating to the documentation and opportunities towards other areas relating to transfer pricing. Vishal, with his expertise over more than 15 years, will be sharing his experiences and will be deliberating on these topics. He is a practicing CA and a partner with Ahuja Walecha and Company. He has also completed his advanced diploma in international taxation UK, ADIT. He has, with his experience over the years, guided the MNCs for the advisory services, and his areas are transfer pricing and international tax for structuring. So I welcome Vishal Solanki for the session, and a warm welcome to all the participants. Over to you, Vishal.
Yeah, thank you very much. And looking forward to have an interactive session. So you all can put your questions in the Q&A session. And in case if time permits, then definitely I'll be answering all your questions. And if any clarification or something is required from my part, then definitely I'll be writing to the respective person over an email once I get the questions.
Thank you. Thank you so much. Over to you.
Yeah. And yeah, so primarily today's webinar is relating to the transfer pricing audit. So what is the role of the accountants audit? That is while issuing the form 3CEB. What all are the verifications that one needs to take care while signing off the form 3CB? So I've put down the agenda as such. Before one needs to sign the form 3CB, one needs to be aware of the relevant provisions relating to what are the definitions, relevant definitions. Then we'll be discussing about the responsibility of the taxpayer as well as the accountant. Then we'll be discussing the accountant's report and the various annexures and what all needs to be verified while certifying the form 3CB. We'll be touching a bit on master file, the CBCR, and what would be the way forward for the year. Yeah. So basically, the main definitions which are relating to the transfer pricing are contained in section 92. So the definition of international transactions, specified domestic transaction, associated enterprises, these are the main things which one needs to understand, because these are the things which one needs to report. So one needs to understand what is the definition of associated enterprise, what are the international transactions, and then we need to see where they fit within the relevant annexures of the form 3CEB. Then there's documentation and certificate. What are the rules for the documentation, and section 92E, which deals with the taxpayer needs to get an accountant's report for the international and specified domestic transactions. There are other relevant provisions also regarding advanced pricing agreements, safe harbor rules, secondary adjustments. Secondary adjustment is basically applicable if the primary adjustment is more than INR 1 crore. Then the CBCR and what all are the relevant penalties for non-compliance. So penalties we'll be discussing both for Form 3CB, the master file, the transfer pricing local file, and the CBCR reporting. As most of you all must have attended a session on 3-tier documentation, just to give you a recap. So even the Indian regulations requires 3-tier documentation. One is the master file. So master file is mostly capturing all the qualitative information about the taxpayer, and mainly it discusses the global operations and the transfer pricing policies. Then there is local file, which would capture the entity specific information from a local perspective. And this is the area where we will be discussing more about the local file. That would be the Form 3CB, as well as the Rule 10D regarding the documentation, because the accountant needs to verify while certifying what all would be the what all are the whether the taxpayer has maintained the documentation or not. Then there's CBCR, which is giving a very high level information of the entity, and it's more of numbers. So you can see you need to give information like the revenue, the taxes paid, capital employed, head count, etc. So now, what is an accountant's report? Now, basically, Section 92E, it requires every person, that is a taxpayer, who has entered into an international transaction or specified domestic transaction, to report or to obtain a report from an accountant on or before the due date. It needs to be mandatorily filed. And what is the purpose of the report? The purpose, generally, this report is divided into 3 parts. First, whether it is examined, what all accounts and records, whether they are examined, whether the prescribed documentation is maintained. So an accountant needs to certify whether the documentation as per Rule 10D has been maintained or not. And the third part contains what all whether the details given in the annexures to the Form 3CB are true and correct. The word true and correct is very important over here. We'll discuss this later. So first, what is the definition of associated enterprises? Because that is the most important thing. Because one needs to identify the associated enterprise. Now, associated enterprise also includes the permanent establishment. Now, and this comes from the definition of the enterprise, which is given in Section 92F. So the definition of associated enterprise is also divided into 2 parts, subsection 1 and subsection 2. So subsection 1 is basically a source definition, which says participates directly or indirectly in management or control or capital, or if one person is holding or is controlling the capital in both the companies, in company A as well as in company B, then that too, it will be considered as an associated enterprise. So this is a direct definition, the source definition. And there's a subsection 2, which is a deeming provision, and it has given 13 different situations. And it's very important that if at any point of time, during the relevant previous year, if it fulfills any of these conditions, then it would be a deemed these would be considered as a deemed associated enterprise. So as we said, the deemed associated enterprise, there are 13 situations, and it is very important that for the purposes of subsection 1, which this subsection 2 supplements the definition as given in subsection 1. I will just explain this to you first of all, why this, or I'll define what is the importance of, the definition of this subsection 2 and why it was brought in. So I'll just read a paragraph from, the memorandum which has brought in this subsection 2. Now, this was brought because now it is proposed to amend subsection 2 of the said section to clarify that the mere fact of participation of one enterprise in the management or control or capital of other enterprise, or the participation of one or more person in the management or control or capital of both the enterprise shall not make them associated enterprise unless the criteria specified in subsection 2 are fulfilled. So it is very important, that the criteria which are mentioned in subsection 2 that are satisfied along with the subsection 1. So in short, subsection 1 is dependent on situations given in subsection 2. Okay, now we'll just give you a brief about what all are the some important situations which are given. So existence of common control, 26% or more of voting power. So it is very important. It is the voting power. So preference shares with no voting power, it is not an associated enterprise. Now, loan advance more than 51% of the book value. In this case, it is the book value and not the market value. And what about the accumulated losses? So in this case, accumulated losses will not be considered. Appointment of more than half of the board. In this case, it is very important that it is the actual exercise of the power which is necessary, and it is not just you have the rights, but not appointing, it will not be considered as an associated enterprise. Complete dependence on the intellectual property. It is more important that it is wholly dependent. So mainly dependent will not be considered, but wholly dependent, yes. Supply of raw material 90% or more. So raw material and consumable, in this case, you need to take a listing and you need to figure it out, how much percentage is from the associated enterprise. If it constitutes 90% or more, then yes, it would trigger. And 10% or more interest in firm, AOP or BOI. So we can see that the definition of associated enterprise under section 92A is much wider, and it's much different than what is given in accounting standard 18. Apart from this, if any entity is located in the notified jurisdiction, then too it will be considered as an associated enterprise. As of now, there is none. There is no such jurisdiction which has been mentioned. Earlier it was Cyprus, but which has been removed. Now, as we had mentioned that associated enterprise also includes a permanent establishment. So what if a foreign branch in India and about its relationship with its foreign enterprise? So a foreign branch in India would qualify to be a permanent establishment, and it would be considered as a separate enterprise than the foreign enterprise. And accordingly, the transfer pricing provisions would be applicable in that case, because it is a foreign enterprise and the permanent establishment in India. Now, if we have an overseas Indian branch and its relationship with the Indian company, in that case, the Indian branch itself is a part of the HO. So in that case, it will not be covered under the definition of associated enterprise. The definition of associated enterprise is much wider than the definition given in the OECD and the UN model. Now, moving on to the definition of international transaction. So international transaction, let's first discuss about the definition of the word transaction. So transaction includes any arrangement, understanding, or action in concert. So it is a much wider definition, and it also mentioned that whether it is a formal, whether it is informal, or whether it is enforceable by law or no, it does not matter. So it is very important that it should be an arrangement, understanding, or action in concert. We'll discuss this, when we discuss something about AMP, the costs which are relating to the advertisement and marketing. So, and the definition of international transaction is given in section 92B1. It's a transaction between two or more associated enterprise, either or both of whom are non-resident. So it's very important that either or both of whom are non-resident. We'll see the deeming definition of international transaction, which says even if it is both the parties are resident, it will still be considered as a international transaction and an associated enterprise. We'll discuss this later. Now, transactions, the definition includes, it's a very exhaustive definition. It includes all kind of transactions. So purchase, sale, and intangible, tangible, everything is considered. And also any transaction which has a bearing on the profit, income, losses, or assets. And there was an amendment in the definition which has given further clarification as to what is the capital financing, business restructuring, and intangible. So the definition is quite wide. One needs to be very careful that mostly all the transactions with the related party or with the associated enterprise will be covered within the framework. So when once look at the definition of international transaction and vis-a-vis the definition of transaction, which is given in 92F. So it has to be demonstrated that the transaction arose in pursuant to an arrangement, understanding, or action in concert. Therefore, factual analysis needs to be carried out to establish whether the AE have any arrangement, understanding, or action in concert. As we had mentioned, like the deeming definition of international transaction. So it's a transaction with person other than associated enterprise. So what in this example, what we have given is there's an associated enterprise. It has an Indian enterprise, which is an AE, and it's a transaction between the third party. So whether the third party, the Indian enterprise, whether it is a resident or a non-resident, it does not matter. If there's some global arrangement or prior agreement for determination of terms in substance. And why this was brought in is because the tax authorities wanted to evaluate whether the profits earned in India is lower because of the influence of the non-resident AE on that transaction. And earlier, the third party, if it was only non-resident, it was covered. But now it says even the resident is covered. So it has become a very wide scope. And care should be taken that this kind of transactions are not missed. Otherwise, there will be a penalty under section 271AA. Going forward, like one also needs to report the specified domestic transactions. And specified domestic transactions are mainly to cover the transactions by the tax holiday unit or entity paying lower tax. And it also includes inter-unit transfer, intra-unit transfers, closely connected persons, and the value of specified domestic transaction should be more than 20 crores to qualify as a specified domestic transaction. So cumulatively, the total value of all the international transactions put together should be more than 20 crores. Otherwise, the provisions will not be applicable. And the definition of enterprise also includes unit or an enterprise or an undertaking or a business of a person. It is very important that all the compliance requirements which are applicable to the international transactions will equally apply to specified domestic transactions. And once this threshold of 20 crore is crossed, So even if there are, small transactions with little value, even they need to be then benchmarked. Now, this section 92D deals with, maintaining and keeping of, the relevant information, which covers local file as well as the master file. So 92D1 deals with, local file, which covers international transactions and specified domestic transactions. And 92D12 deals with, the master file. So if it is a constituent entity of an international group, they need to maintain the master file. Whether it will be part A or part B, we'll discuss this later. And there's also a very important change in the budget, wherein, earlier the time allowed was 30 days for the assessee to submit the report. Now it has been 10 days. So 10 days, and then further grant of another 30 days can be given. So it has come down from 30 to 10 days and from 60 to 40 days. And for permanent establishments and for non-residents, the relevant clauses of 10D1 would apply, not all the clauses. And what is generally, the rule 10D1, generally it gives you the ownership structures. So it gives you the relationship between the associated enterprise and the related party. Then what are the international transactions? Then there will be a detailed section on how is the comparability done, which is the best method, or which is the most appropriate method which has been selected, what are the comparables, or if the cup is used, what is the data, and what and how it has been determined at arm's length price. And very important is that rule 10D1 10(1) is not applicable if the value of international transaction is less than 1 crore rupees. We'll discuss in case what happens if the value of transaction is less than 1 crore. So what all checks and balances which the accountants needs to take care when this value is less than 1 crore. Now, the responsibility of the taxpayer, if it mainly comes from section 92D, which says that any person and every person who has entered into international transaction or specified transactions shall keep and maintain such information and documents. Then there is section 92D3, which says that the tax officer may call for the information and which needs to be submitted within a period of 10 days and which can be extended to a further period of 30 days. Then 92E deals with the definition which deals with the accountant's report, which needs to be obtained by the taxpayer, whoever is having international transaction or specified domestic transaction. Like unlike in 92D, it says that less than 1 crore, you don't need to maintain the transfer pricing documentation. But 92E, which even if the value of transaction is 1 rupee, you need to get an accountant's report. Section 286 it deals with the CBCR. So it says that every parent entity or an alternate reporting entity who is resident in India shall furnish the report. Now, why this the responsibility is cast on the taxpayer? Because he is in the unique position of being in control and custody of information to demonstrate that the transactions are on arm's length price. So if we see that section 92D 92E, it says that the assessee needs to get an accountant's report. So who is an accountant? So the accountant is having the same definition as given in subsection 2 of section 288. Accountant is a chartered accountant. Then Now, before accepting any assignment, you should communicate with the previous accountant. Now, this is as per the code of ethics. Now, it prohibits a relative or employee of an assessee for being appointed as an accountant. So don't have any relative. So a relative or an employee should not, be signing the Form 3C. So, and also if anybody is writing the books of accounts, then even he should not be signing the Form 3CB. Internal auditor is also should also not conduct the examination under Section 92E. Tax consultant, yes, they can conduct the examination under Section 92E. Now, what if the report is not furnished within the due date? So, whose responsibility it is? So, in generally, it is said that it is it is the professional duty of a chartered accountant to ensure that the examination accepted by him is completed before the due date. Only if if there is unreasonable delay on his part, then he is answerable to the institute. Otherwise, it is the information needs to be provided ideally by first the taxpayer, and then the accountant needs to work on it. What is this accountant report basically? It what does this report contain? So whether the assessee has maintained the proper information and documentation, that is the transfer pricing report, to demonstrate that it is at arm's length price, and so he just needs to express an opinion, and for the particulars to be annexed to the report, that is annexed to the Form 3CB, he is required to give his opinion as to whether they are true and correct. Need to maintain working paper. So these working paper can be something like the explanation and the information obtained while doing the test checks. Then the various decisions on various points taken, judicial pronouncements. If any certificate has been issued, the management representation letters, and so it's then coming to the next point, it is true and fair. So true and fair, one can rely on test checks. So that would suffice doing a test check generally at the time of statutory audit when the accountant needs to express an opinion. But when you are saying true and correct, you need to there will be an additional step which says that you need to apply a reasonable test. Now, there will be certain transactions where it will not be directly available from the books of accounts. So in that cases, we need to place reliance on the taxpayer, like deemed international transaction, free of cost goods. Now, for non-residents, now if any accountant's report is issued to a non-resident, then such non-resident is not required to maintain books of accounts in India under any law. So the accountant should place reliance on Form 26 AS, invoices, agreements, etc. What if there is a difference of opinion under para 3, that is whether true and correct, whether the particulars given in annexure to the Form 3CB, whether it's true and correct, and if there's some difference of opinion, then the accountant should make a specific reference to those clauses in the Form 3CB in which he has expressed his reservation, difference of opinion, and disclaimer. If what if there's a piecemeal or an incomplete information? So whether the accountant should completely withhold giving this report, or whether he can still give an report. So it is said that the accountant should not withhold the entire report. In such a case, he can qualify his report on matters in which respect of which information is not furnished to him. So if information is not furnished, he should just qualify the report, and he should mention in the relevant para what all are the information which is missing. Okay, what is the what happens if there's a misconduct on part of the accountant? he'll be liable under the Chartered Accountants Act 1949, and ICA disciplinary jurisdiction will prevail in this regard. As well as there's a section 271J, which levies a penalty on accountants for furnishing inaccurate information, and which can be around 10,000 rupees per report. So we'll start off with the accountant's report, basically the Form 3CB. So the para 1 says that examine the account and records, and it is in relation to an international transaction and specified domestic transaction. So the scope is limited to international transaction and specified domestic transaction. The whole purpose of this report is whether the particulars disclosed is true and correct. In case if the financials are audited by other accountants, it is definitely reasonable to rely on the correctness of the information, including the completeness, unless there are some obvious or significant discrepancies. Additionally, he has to do the following. He should undertake due diligence about the reasonableness, that is take on test check basis, reconciliation, and also obtain a management representation. And he needs to state that the figures are relied from the Auditor General Purpose Financial Statement. Now, while doing the audit and the verification, I have taken the inputs from the guidance note on report under section 92E of the Income Tax Act, which was revised in 2022. He needs to apply sampling test which may be deemed proper depending on the internal control procedures followed by the SSC. So it is primarily necessary for an accountant to identify and assess the risk of material misstatements. It is very important that the concept of materiality should be kept in mind. Now, completeness relating to the listing of international transaction, it is the responsibility of the SSC. Accountant should use his professional skill and expertise and apply such tests as the circumstances. So it is the responsibility of the SSC, but the accountant also has to, do some test check basis and determine whether the information provided is complete or not. So few of some tests would be the CIF value of imports, or the FOB value of exports. We can take an entire listing and you can see if there are any related party and whether they have been reported or not. Then there will be AS18. So there can be some reconciliations which the accountant should also need to go through it. As we mentioned that the deemed international transaction is nowhere recorded in the books of accounts, and it will be very difficult for the accountant to identify what are the deemed international transactions. In that case, it is the responsibility of the SSC, and we need to rely on the representation given by the SSC. But management representation to be taken, but the accountant should exercise his professional judgment. So pure management representation will not work. At times when things can be verified, it needs to be verified. Now moving on to para 2. So it mentions that the accountant needs to give his opinion whether proper information and document as are prescribed have been kept by the SSC in respect of international transaction and specified domestic transaction. So it needs to give an opinion on compliance of Rule 10D1. So accountant needs to review the documentation and compare with Rule 10D. We'll discuss clause by clause Rule 10D, what all it contains, and what all the accountants need to verify. It's very important that the list mentioned under Rule 10D are prescriptive in nature. So it is not necessary that all the points needs to be covered. It depends on case-to-case basis. If the accountant is satisfied with the documentation, then no qualification is required. If it is not, then yes, we'll discuss. So the next bullet is like, if he's not satisfied with the documentation or qualification, then he can either qualify or give a note depending on the facts of the case. The qualification, if any, given should be self-explanatory and comprehensive. We mentioned that if it is less than 1 crore, then 10D will not be applicable. But still, Rule 10D2 says that the assessee, the taxpayer, needs to substantiate that it is at arm's length price, and the accountant is also required to verify whether any material is there and needs to examine also. For HDT, there is no such threshold, unlike 1 crore for international transactions. So if HDT is more than 20 crores, then it was applicable for all the transactions. So point by point, if you go to Rule 10D1, basically the first clause deals with the ownership structure. So this is more of the transfer pricing documentation which is maintained by the taxpayer. So the ownership structure, the accountant may rely on the financial statement and the representations, the registers and all this. So the profile again needs to take a test check of the documents and records of the assessee. So one can get a better profile from the master file, the CBCR, the tax audit report, and even the register of members. Broad business description. So the material published in business newspapers and trade journals can be referred. So nature and terms of the transaction. So one needs to carry out a standard examination procedures from books and information explanation obtained during examination. FAR, that is the functions, assets, and the risk. The accountant is required to take a representation that all the functions are covered and it is complete in all aspects. Economic and market analysis and forecast. He needs to obtain the copies of the forecast and budget, but need not comment on the appropriateness. So accountant is not required to comment whether it is appropriate, it is inappropriate, or anything of that sort of. Uncontrolled transaction. The accountant shall examine details of the comparable transaction data compiled by the assessee. Analysis performed to evaluate the comparability. He needs to the accountants if in the accountant in annexure to form 3CB needs to mention the method, and so that is why one needs to go through this report. He is not obligated to ascertain whether the method is the most appropriate method. He just has to rely on the report. Actual working of the ALP, that is arm's length price, including any adjustments. He needs to examine the correctness of such working and adjustment made with reference to the relevant data and if there are any policy assumptions and negotiation, the accountant shall obtain information, understanding of the business and the commercial reason, if there are any losses. So if there is any strategic decision or something, then he needs to obtain that information. Also, he can take that by way of a representation. If any adjustment is made to the transfer pricing, arm's length price, then yes, that is also very important that he should review that adjustment, because that will also be required for the while computing the taxable income. And there's the last clause, that is any other information. So the accountant may, what all other information which may be available, he needs to verify that information also. So basically, para 2 of the Form 3CB, it says that the accountant is required to go through the transfer pricing report and give his opinion whether the information has been maintained or not. It does not say that it is true and correct. It is just say it mentions that whether it has been kept. Now going to para 3, it says that the annexures to the Form 3CB, whether they are true and correct. So basically, the scope in this is, the assessee should provide the information and it should be authenticated. It should be the information which has been provided by the assessee, that is the taxpayer. It needs to be reviewed by the accountant. So as we had already mentioned, that the accountant is only required to ensure that the method stated as being used in determining the arm's length price has actually been used, and it is not the accountant's responsibility to ensure that the method so used is the most appropriate method. So no comment on, we should not give any comment on, whether this is the most appropriate method or the other one is the better one. And he may mention that certain points in the certificate is subject to certain clauses of annexure in Form 3CB. Important aspects is while conducting such audit is one needs to keep have some give some emphasis to the concept of prudence, substance over form, and materiality. And materiality is the most important, which one needs to keep in mind. Annexure, there are 3 parts. It has 25 clauses. And as we mentioned that it needs to be obtained from the, initially it needs to be obtained by the taxpayer itself. What are the general rules for the accountant? So if any particular item is in more than one annexure, then make a suitable cross-reference. If there is any difference of opinion, state both views. If a particular annexure is not applicable, please mention that it is not applicable. Annexure should be based on the books of accounts, records, document, information, and explanation made available to the accountants for his examination. Now we'll go through each of the clauses of the annexures. So part A is general information about the taxpayer, that is the name, address, and all those other details. Part B generally deals with the international transactions, and Part C will considers the specified domestic transactions. So Part B is we'll start with clause 10. So it gives the we need to give the list of associated enterprise with whom there are international transactions. So assessee needs to provide the list, and one can also refer to the master file and the CBCR report. If there is any difference of opinion of whether it is an AE or not, then try to mention the relevant facts in the note. Okay, it's very important that only the taxpayer with whom it has international transaction, that is only to be reported. So even in this list, it will only be the associated enterprises with whom there are transactions. So if there are more than one relation, so it is then it is sufficient that you mention only one disclosure. You don't need to mention 2 relations or under different clauses. Accountant must exercise reasonable care that the list is reasonably complete and can use the following reference. So one can refer to AS 18. Then if there is any investment transactions or if there is any structuring that has happened, so they can refer to that, the relevant documents. And also one can look at the master file and the CBCR to just cross verify that the list is complete. And for the deemed international transactions, the accountant should obtain appropriate management representation. So clause 11 generally deals with the tangible property. So 11A, it considers raw material. So whatever material which is used for manufacturing, then that needs to be reported here. Any material which is sold before the consumption during the normal course of business, that will also be reported. So purchase and sale, both the transactions. Then for in case if there is no, it is not possible to give the quantitative details, then the accountant should mention why it is not possible and give a clarificatory note. Clause B deals with purchase and sale of traded goods and finished goods. So it considers both traded goods and finished goods, which are the SSC trades in. Clause 11C deals with any other tangible property. So it will be considered, so capital goods will fall under this category. Clause 12 relates to the disclosure for transactions which are relating to intangible property. As we had already discussed, the explanation in the definition of international transactions, there is a change in the definition of there is an explanation given to the definition of intangible property, which is quite exhaustive. So I think most of what all one can think of, everything is covered in that explanation. So what is an intangible? Generally, it is anything which derives its value from the intellectual content rather than physical activities. So it is not, it may not be separately accounted in the books of accounts, and one needs to rely on the TP documentation and the representations. One can also find, some intangibles from, reviewing the past records and the past transfer pricing assessment orders. And so even in the master file, if there are a lot of details regarding, the value drivers given. So one can, go through the master file and also see that, it is in line with what all information you're disclosing in clause 12. So whether an AMP would be considered as an in this. So as we mentioned that, whether for any transaction, whether it is done for itself or whether it is done on the behest of the foreign company, one needs to see the factual, would need to seek factual information and then decide whether it should be really considered as an AMP or it should not be considered as an AMP. So if the Indian company is incurring expenditure mainly for, developing the local market itself, it is not, instructed by the foreign company to do this, then in that case, the expenditure will, in most cases, it will not be considered as an AMP. Clause 13 deals with the services. Again in the explanation to the definition of international transaction. This is quite wide. It includes provision of market research, market development, marketing, management, administration, technical, commercial, repairs, design, scientific research, legal or accounting services. So it's quite exhaustive. So all kind of services, both availed or rendered, they need to be reported here. When the benefit test needs to be seen, what if there are incidental benefits? So generally it says that that should not be considered when the company obtains any incidental benefits, mainly attributed solely to being a part of the large concern and not to any specific activity being performed. So incidental benefits, just because it is a part of a big organization and it is receiving those benefits, it should not report those transactions. Clause 14 deals with lending or borrowing of money. So all kind of loan or advances, everything needs to be reported here. And if one really looks at this clause, it will be non-convertible, preference shares or debentures. So convertible will be reported at other place, which we will discuss. In this clause, the currency denomination should be clearly indicated. What about advances? So one needs to carefully consider this and needs to evaluate from the entire business of the taxpayer. And if the advance is for any underlying primary transaction, then you need to mention very clearly in the clarification by way of a note. Guarantee, clause 15. So the definition as such is not mentioned. So all kind of guarantees needs to be reported here. If one needs to look at the definition of guarantee, that there is one definition given in Rule 10A C, which defines only the explicit guarantees to be the guarantees and not the implicit guarantees. So letter of comfort ideally is not a guarantee as per Rule 10A C, but that is a different. It is not defined under the particular scheme of things under the Form 3CB. There are case laws which says that letter of comfort is not considered as a guarantee. One needs to go through the details and the facts of the case to determine this further. Clause 16 deals with purchase or sale of marketable securities, issue buyback of equity shares, and also convertible preference shares and debentures. Though the premium arising is not a taxable transaction, it is purely a capital account transaction, and hence it is not liable to any transfer pricing adjustment, but one needs to report these transactions under clause 16. Clause 17 deals with mutual agreements and arrangements. So these are basically agreement agreement or arrangements which represent an understanding. So if there is any reciprocal benefits, or if there is a sharing of cost and the risk of jointly developing of any asset or providing any services or benefits, then these kind of transactions need to be reported under clause 70. So all cost contribution agreements and mutual agreements and which have been entered into between two associated enterprises, wherein they come together and provide or they jointly develop some intangible, or they provide services to each other, then this will be included under this clause. Okay, clause 18 relates to business restructuring or reorganization. So the definition is nowhere defined under the Act. So business restructuring can be any operational change or organizational change. Now, there's a chapter on in OECD which deals with business restructuring. Given the indicative list, so if any conversion from a full-fledged to a limited risk distributor, conversion from full-fledged manufacturer to a contractor, transfer of IP, rationalization, specialization of operation, downsizing, or closing of operation. So one needs to see whether it really amounts to international transaction. Clause 19 deals with any other transaction, so it's a residual clause. So generally, one reports reimbursement, free of cost goods and services. So free of cost goods and services, the accountant can verify from the positions taken under the GST. So if there is any free of cost goods moving from one social enterprise to another, then one needs to see so what is if one can find any records under the GST, and it needs to be appropriately recorded. As we mentioned, what about intentional set-off? It could be reported in the Form 3CB if there is any intentional set-off, and one also needs to give a note as to how this transaction has been set off. Deemed international transaction, that is clause 20. Accountant should basically obtain management representation. We should also explain what generally could be deemed international transactions, so that even the taxpayers is aware of what information the accountant is seeking. Okay, Part C deals with specified domestic transactions. So clause 21 again, you need to give a list of the enterprises with whom there are specified domestic transactions. So in this case, the accountant can review the return of income of the SSE, and you can definitely determine if any tax holidays status is claimed by the SSE, or if any tax exemptions are being claimed. And as we mentioned, that the definition of an enterprise under specified domestic transaction also includes a unit. So if an SSE is having two different units, one claiming tax benefits and the other not, then even in that case, the transaction between these two, the one claiming tax holiday and the one not, you need to report those transactions. Earlier there was one clause which mentioned that any transactions with a person referred to in 40A2B. So with the amendment in section 92BA, this clause has been deleted. Clause 22 deals with mainly relating to goods and services. It is a transaction between SSE and mainly those which are referred to in 80I and 80 I8. So 22A deals with sale of goods and services from eligible business unit, and 22B deals with purchase of goods and services. And so these are 80I and 8 and 80I 10. So it mainly deals with the profit linked incentives. So it could be anyone in the development of special economic zone in certain industrial undertaking other than infrastructure development undertaking from housing projects. It's a wide list, so one needs to go through this section. Okay, and 23 deals with any business transacted, which has resulted in more than ordinary profits, and it mentions that more than ordinary profits. So what if it does not result in more than ordinary profit? In that case, the assessee need not disclose. And this definition is much more wider because it also covers close connections. So even if there's no relation, but but because of the close connection, if anyone claiming more, if anyone is claiming higher tax benefits or leveraging because of the close connection with some other person, then even he becomes a close connection, and then this thing need to be reported, but it should be more than ordinary profits. And for this, there has to be a robust transfer pricing documentation, which the accountants need to verify. Why are we saying that they are not earning more than ordinary profits? Clause 24 deals with the transactions by the person mentioned in 115 BAB subsection 6, and even in this case, you need to report transactions which are because of which there are more than ordinary profits. In case if there are not more than ordinary profits, then no need to report those transactions. Clause 25 deals with any other transactions, and it's a recidivism clause. So we have covered the Form 3CB and annexures and the various parts, and what all are the verification that the accountant needs to do. Moving forward, what all are the penalties? Now, penalties, just to give just a snapshot of what all are the penalties. So failure to maintain documents as per 92D1, 2% of the value of international transaction. Failure to report a transaction in accountant's report, again 2% of the value of transaction. Maintaining or furnishing incorrect information or document, 2%. And failure to furnish the accountant's report. So if one does not submit or the taxpayer fails to obtain a accountant's report under 92E, then it will be 1 lakh rupees. Failure to furnish documents, if asked for, then 2% of the value of the transaction. So the penalties are quite high because it is directly 2% of the value of the transactions. Then if any transfer pricing adjustment is done, then section 270A comes into play. So if it is underreported of transaction, then it is 50%, and it shall not be an underreported income if the assessee has maintained the documents as per 92D, declared the international transactions, and disclose all the material facts relating to the transaction. It is 200% if it is considered as a misreporting, and misreporting includes failure to report any international transaction or transaction deemed to be an international transaction or specified domestic transaction, to which the provisions of chapter 10 apply. So it's very important that how well you identify the associated enterprise, then the relevant transactions, because non reporting or misreporting can, if there is any transfer pricing adjustment, then the penalty can be around 200% of the tax payable, which is a very high penalty. Going to the next one is the master file. To whom it is applicable. If the consolidated group revenue of is more than 500 crores, and the aggregate value is more than 50 crores of the international transaction, or 10 crores involving intangible properties. So consolidated group revenue, in the sense of considered entity, would be, it will be mainly applicable if there are two companies and both are tax resident of different countries. So there are two requirements. One is more than 500 crores and 50 crores, or 10 crore international property. The penalty for non-compliance is 5 lakh rupees. It is nowhere specifically mentioned that Part A or Part B, whether 5 lakh would be applicable. So master file has two parts, Part A and Part B. So Part A is basic details. So even if the above the criteria which is mentioned for applicability of master file is not satisfied, still all the constituent entities will have to submit Part A. Part B is quite exhaustive. So Part A and Part B will be applicable if these conditions are satisfied. And Part B contains organizational structure, the M&E business, the intangibles, intercompany financials. So it contains the entire, the operations, what are the value drivers of the business. It's quite qualitative report wherein, not much numbers, but yes, the entire business is explained. The CBCR is contained in section 286(2). It is applicable to every parent or alternate reporting entity who is a resident in India, and the consolidated group revenue exceeds 6,400 crores. Failure to submit CBCR, there's a penalty on per day basis, which can be 5,000 to 50,000 per day. It depends. Generally, what are the contents of CBCR? It's more of financial information about the group. Part A covers the overview of the allocation of income, taxes, and business activities by tax jurisdiction. It also includes the revenue bifurcation between related party and non-related party. The capital also needs to be stated. Accumulated earnings, number of employees. So, if CBCR, one can find out, where the main business is based on the number of employees, as well as if any particular jurisdiction is earning what are the revenues based on the number of employees. So one can do a lot of statistics and analysis to identify various risks. Part B generally contains all the constituent entities of the group along with the main business activity. So for master file, we did not see any failure for inaccurate details, but yes, for CBCR, failure for inaccurate details is again file approach. So what we can see is there are three requirements, three buckets. One is the local file, wherein we will be requiring the SSC will be requiring to get an accountant's report, that is Form 3CP. The due date is 31st of October. Transfer pricing documentation, it needs to be maintained. Nowhere it needs to be filed. It needs to be prepared by the due date. Master file, there are different due dates. So Part A is 30th November. Part B is again 30th November. Part B is applicable if the threshold is met. So Part A, no matter whether the threshold is met or not, it is applicable. And if there are two entities and if only one entity needs to file, and so there's something called as designation, wherein you can designate one entity to intimate the Form 3CB or 3CEAB, and it needs to be intimated 30 days from prior to the above date. That is 30th of November. You need to intimate 30 days before that. CBCR needs to be submitted within 12 months from the end of the accounting year. Intimation by Indian constituted entity or foreign parent entity 2 months prior to the date of filing the CBCR report. And there's also an intimation required for reporting the constituted entity filing under certain circumstances. Okay, should we take up questions?
Yes, sir.
Yeah.
Request all the participants to please use the Q&A tab.
Okay. Yeah, so there are a few questions. The first one is, if unrelated, how can TP be applied and reported so? If unrelated, does Akshay means to say something like deemed international transaction? So TP is applicable because the tax authorities they sometimes see that because of some foreign negotiations happening between the assessee and the third party, then in that case, yes, one needs to see whether there is whether the transactions between the lower parties, that is the Indian entities and the other unrelated entity, whether they have been, whether it is having any profitability impact on the same. The client, the next one is Ujjwal Jawar. He has asked, the client is currently providing market and data analysis services. If we are following cost plus model and not TNM, in that case, if the actual markup is if similar, I think that is an incomplete one. I'll read the next question again posted by Ujjwal. The client is a subsidiary company and currently they are providing market and data analysis services. If we are following cost plus model and not TNM, in that case, if the actual markup for providing to a customer directly by a parent co is say 35 to 40%, whereas for us, we are following safe harbor rule and billing parent company with 20% markup. It is an unlisted company and all other competitors are very big in size, and thus we do not have any direct comparable. Is this approach correct or wrong, and whether the tax officer can question and ask for details of billing of the parent? So if the safe harbor, if you are using the safe harbor rules, and if so safe harbor, you cannot just use the safe harbor rules. You need to get it approved. So so one cannot take the rates which are mentioned under the safe harbor. Those are the benchmark rates, but one cannot rely on that. In the sense, one needs to still prove that it is at arm's length price. And regarding the factual analysis, see, transfer pricing requires a lot of, the factual analysis of the transactions. So that will include, the market in which it is operating, and also when comparing, it is not very, when you're using the TNMM, there can be cases wherein, you may not find comparable. So there can be some relaxations in that also. The next one, if we have received income in advance from the parent company, in that case, should we even disclose that in the, yes, that should be disclosed under loans and advances. Should we even report any transfer of assets from our DTA to SEZ as transfer of fixed assets in TP report? So one may report this under the residual clause as a matter of abundant precaution. Whether merger of two Indian E should be reported under clause 18. Whether merger of two Indian E should be reported under clause 18 of Form 3CB. In that case, see, one needs to see the definition of business restructuring. So business restructuring will also include, the corporate restructuring, and we need to determine, either by way of note or something as to why this is a international transaction. So a more detailed analysis should be considered. Yes, and your point is valid. One needs to look into this clause before, finalizing things. How to apply reasonable test check basis. So this is purely, professional judgment. One needs to use this professional judgment, as well as if and also one needs to see, if there are a lot of, obvious errors or something, then your test or your sampling size should increase. And also one needs to evaluate the internal controls and, the framework of the company. So it will, so once you have start having discussions and around all this, one can, try and find out, how much is the reasonable test that it needs to carry out. What if the master file is not filed as the parent company does not want to disclose their turnover? No, the consequences are, if any which ways in the master file, you don't need to disclose the turnover anywhere. So if the global consolidated turnover is more than 500 crores, and if your value of international transactions in India is more than 50 crores, or it is more than 10 crores of intellectual properties, then it needs to be, the master file needs to be filed. So there is no place where you need to mention the turnover. What comes in other methods? So generally, the quotations or something of that sort of, or the valuation report, they may be considered in other methods for determining ALP. If there are any free of cost assets received by the assessee, how to assess the arm's length price? and how to disclose the same in Form 3CB. So if there are any free of cost assets received by the SEC, then definitely it is beneficial to the Indian tax revenue. How to assess the arm's length price? As I mentioned, if it is free of cost received, then it is definitely beneficial to the SEC, and disclose under clause the residuary clause, that is clause 19. Ujjwal Jawhar has mentioned if master file is filed, won't CBCR report even be? No, CBCR and master file, the threshold limits are different. So for master file, it is a different threshold, and for CBCR, needs to be the reporting needs to be done if the value of the consolidated turnover is more than 6,400 crores. Rohit Kamath has asked if the only international transactions of Indian subsidiary with AE is of a nature of purchase of raw material, if almost 90% of the raw material is purchased from AE, is TNMM a correct method, or any other method is more appropriate? Rohit, generally for choosing the most appropriate method, there is 6 steps which needs to be factored in, and one cannot directly jump into the TNMM as the most appropriate method. So the facts needs to be considered. Yeah, ma'am, I'm done, ma'am.
Yes, so the participants, we would like to share that Vishal has kindly agreed to share the presentation, so which we will be sharing with you all in a couple of days. And if any other questions, maybe next 2-3 minutes, we can have the Q&A tab open. In the interim, if anyone has any specific queries, you can also feel free to reach out to the faculty, Vishal sir. He has shared his coordinates.
Yes, there's one more question which has been raised by Pranjali.
Yeah.
It says that free of cost assets are beneficial to assessee. However, TPO may take a view that the cost of the same should be included in the cost base, and appropriate premium should be added to our. Yeah, it's a very valid point. So if any, so first of all, free of cost assets. So generally, it will be the depreciation which will not be charged back, and if depreciation is not charged, so there will not be any markup on that. So yeah, when it's a cost plus model, yes, the TPO may take this view. You're right, Pranjal.
Thank you so much, Vishal sir, for your valuable time and a wonderful knowledge sharing session. It really means a lot to us for your presentation and the time. To all the participants, thank you for keeping the Q&A tab busy throughout. It was a wonderful interactive session, we must say. We are grateful for active participation. Such encouraging participation and the valid questions encourages to all the organizers as well. Thanks a lot. And Vishal sir, thanks for sharing the presentation.
Yeah, thank you. Thank you, ICI, for giving me this opportunity, and thank you all for patiently listening to me. Thank you very much.
It was a wonderful interaction. Thanks to the technical team here at the Pune branch for the technical support throughout the session. Thank you. See you all soon tomorrow for the last day of the 10-day refresher course on the international tax. Thanks a lot.
Thank you, ma'am. Yeah.
Bye.
Thank you.